Three people walk into the exact same bank on the exact same morning. Same logo above the entrance. Same marble floors. Same smiling receptionist near the front desk. But from the moment each one steps inside, they are no longer entering the same institution. The first customer has $45 left in his checking account. Not $4,500, not $450, just $45. The second has $100,000 spread across checking, savings, retirement, and a taxable brokerage account. Comfortable, respectable, the kind of balance that makes you feel like you're finally doing adulthood correctly. The third has $5 million parked across private banking, managed investments, trusts, and business accounts. And this is where things get interesting. Most people think wealth changes what products a bank offers you. Better rates, nicer cards, maybe a waived fee here and there. That's true, but it's also the least important difference. The real difference is that these three people are not treated like variations of the same customer. They are treated like entirely different species. Same bank. Same day. Three completely different realities. I'm Professor Wealth, and today I'm showing you exactly how banks treat you at every level of money. Meet Alex. He's 31, works operations for a distribution company, makes a decent salary, and like millions of people, his financial life runs on timing, not abundance. Timing. Rent hits on the 1st, car insurance on the 3rd, credit card autopay on the 5th. Payroll lands on Friday, unless there's a holiday. His balance today is $45, not because he's irresponsible, but because life is expensive in ways budgeting videos never fully capture. Then there's Ryan, 38, corporate sales, married, financially organized. He built up $100,000 over years of consistency, cautious investing, and avoiding obvious financial disasters. He feels stable until he talks to people wealthier than him. Finally, there's Michael, 54, sold a software company 8 years ago. Investable assets just north of $5 million. His money now works harder than most people do. All three bank at the same institution. But what happens next makes it clear that a bank is not one business. It is multiple businesses disguised as one. Alex stops for coffee before work. His card gets declined. He checks his phone. $45 became $9 overnight because a subscription renewed and a utility payment posted earlier than expected. He buys nothing and leaves embarrassed over a $7 purchase. A pending transaction later pushes him negative. By lunch, he gets charged a $35 overdraft fee. Not a warning, not a courtesy text, a fee. Automated, immediate, clean, and efficient. Ryan experiences something similar once. A vendor payment clears before a transfer from savings finishes processing. Briefly negative by $60. But Ryan gets a text. He transfers money within the hour. The fee appears, then disappears after a quick phone call. As a courtesy, we've waived it. Same issue. Same bank. Different outcome. Michael never deals with this. His accounts are linked to a standby line of credit. If anything ever falls short, funds automatically cover it. No embarrassment. No fee. No decline transaction. No friction at all. In fact, if something unusual even looks like it might happen, someone from his banking team notices before he does. The penalty Alex pays for lacking $35 is structurally impossible at Michael's level. That is not an accident. Banks collect enormous revenue from small mistakes made by people with the least room for error. Alex is profitable in a way Michael simply isn't. All three need to visit the branch this week. Alex walks through the main entrance, takes a paper number, and waits behind 8 people. Fluorescent lights, plastic chairs. A muted television looping market headlines that have absolutely nothing to do with his life. 22 minutes later, a teller calls him up, handles his deposit in 90 seconds, and moves on. Transaction complete. Human interaction over. Ryan comes in later, less crowded. He waits maybe 7 minutes. Deposit gets handled. On his way out, a banker notices his profile and casually asks if he'd like to schedule a financial review. Not urgent, not personal, just opportunity detection. Michael doesn't use the lobby. He parks in a reserved section beside the building. A private banker meets him directly and walks him upstairs. No lines, no numbers, no waiting. He sits in an office with espresso already prepared. The conversation isn't about deposits. That gets handled quietly in the background. They're discussing tax loss harvesting, a commercial property refinance, and estate planning updates. Alex visited a bank. Michael visited an advisory firm disguised as one. Same building, completely different business model. Then all three need money. Alex needs $4,000 for emergency dental work and car repairs in the same month. He applies for a personal loan. Denied. Too much recent volatility. Average balance too low. Risk score unfavorable. Instead, he's offered a secured credit card. Put down cash to borrow your own money back at a high interest rate. Ryan wants $25,000 for a home renovation. He applies online Sunday night. Approved Tuesday morning at a competitive rate. Funds arrive quickly. Smooth. Predictable. Functional. This is what most financially healthy people assume banking is. Michael needs $2 million temporarily to close on an investment property before liquidity from another asset sale arrives. No forms. No underwriting portal. No anxious waiting. One phone call. His banker discusses terms directly. The rate isn't advertised. It isn't publicly listed. It is negotiated. This is the part people misunderstand about money. The more you need capital, the more expensive capital becomes. The less you need it, the cheaper and easier it gets. Alex gets offered expensive money. Ryan gets offered fair money. Michael gets offered strategic money. That difference compounds long before investing ever begins. Eventually, something goes wrong for everyone. Alex spots a duplicate charge. He calls customer support. Hold time. 31 minutes. The representative is polite, clearly reading from a script, and authorized to solve only routine issues. Escalation required. Resolution estimate, 3 to 5 business days. Ryan calls because a fraud alert locked his card while traveling. 6-minute hold. Issue resolved during the same call. Mild inconvenience. Michael doesn't know the customer service number. He has never needed it. He texts his banker. Problem solved before most people finish explaining theirs. No escalation. No queue. No script. Direct authority. That is what wealth often buys more than luxury. Reduced friction. Even fees tell the story. Alex asks if his overdraft charge can be reversed. He explains timing. Payroll delay. Small balance. The answer is polite, but firm. Policy is policy. Ryan notices a transfer fee. Calls. It gets waived as a courtesy. Michael never sees these fees. They disappear before posting because his relationship tier automatically suppresses friction. Same fee schedule on paper. Different application in reality. Banks don't usually break rules for wealthy clients. They don't need to. They simply apply discretion where relationships justify it. And that discretion is where the real game is played. Now, let's talk mortgages. Alex wants a modest starter home. Lower down payment. Higher perceived risk. Higher rate. Mandatory mortgage insurance. Over decades, he pays massively more relative to what he borrowed. Ryan buys a larger home with stronger credentials. Better rate. Lower borrowing cost per dollar. Michael buys a multi-million-dollar property with terms most people never even see displayed online. Lower rate than both of them, despite borrowing the most. Read that again. The customer with the fewest resources pays the highest price for access to money. The customer with the most resources pays the least. Not because the bank is evil, because the bank prices risk and values relationships. But the result is the same. Wealth receives efficiency. Scarcity receives penalties. So what does the bank actually know about each person? Alex is mostly data. Average balance, payment history, risk score, product eligibility. The system does not know his context. It does not care that one bad month can destabilize 6 others. Ryan is a recognized customer, not special, but worth retaining. Marketable, upsellable, replaceable. Michael is not just a customer. He is a relationship. Someone's compensation, retention metrics, and performance review partially depend on keeping him happy. That changes everything. This is the real divide most people never see. At lower levels, you are processed. At higher levels, you are served. The bank is not your friend. It is not your enemy either. It is simply a business constantly calculating your value to it. Once you understand that, banking starts making a lot more sense. If you're Alex, your first mission is stability. Eliminate chaos. Build margin. Escape expensive money. If you're Ryan, you're stable, but not yet strategically valuable. More assets means more leverage. More leverage means more options. If you're Michael, none of this is surprising. You already know the system gets smoother the less you need it. Same bank, same brand, entirely different worlds. I'm Professor Wealth, and if this changed how you think about money, the next step is understanding exactly what moves you from one tier to the next.